Welcome back, everybody. Well, let's get to the commodity markets. Jonathan Barratt joins us, Managing Director at Commodity Broking Services, and still with us, our guest host, Tony Cripps from HSBC. Jono, good to see you once again. Yeah. You have said this many times on our show, and we're going to say it once again. Oil inventories continue to build, and yet the price of oil doesn't go down. Why not?
Well, that's a question which we hopefully can provide the answer. What we're finding is that at the moment everyone's still a little bit US-centric in what's happening. We're not seeing the unemployment data doing what we expect it to do. We're also concerned about economic growth. But as that all starts to retreat, the Greece sovereign debt comes under control, we're not getting all these negative things, people are going to start to question, hang on, these economies are starting to move and they need energy. And that's why we think the builds are there to placate the demand in the future. And I think that's what investors are actually seeing.
But we can't get above $80 convincingly. Why not?
Well, once we do, right, and once there's a little bit of a kick in it, then we could see it onwards and upwards. Because I think you've really got to look at where the market is placed. Now, inventories are not as high as they were in the first quarter of 2009 when the GFC was with us. So you think that those inventories can be used up quite quickly if, in fact, our economies start to move full steam ahead.
Yeah, makes sense. Sri?
Thanks, Mandy. Jono, I want to dig a little bit deeper into the inventory report from the EIA because I did think that there were some significant points there. Refinery utilisation was up more than the market expected. 4-week average demand was up by 3%. 1 week's data doesn't make a trend, of course, but how much of an inflection point are we at? Is demand finally starting to make a comeback in the US?
Yeah, Cherie, that is an important point. But we feel we are at that inflection point because all that negative data, it's out there and it's meant to depress prices. But we are starting to see a little bit of lift, a little bit in confidence. Throughout the week, we had manufacturing a little bit better. Jobless claims sort of a little bit lower. All this data is starting to suggest that things are moving. I do think the crux will be the unemployment data out tomorrow night to see whether what we're thinking will be fulfilled. And if that is the case, then I feel we will break through this US $81 a barrel and we could be trading onwards through to US 85 and 88 and maybe even higher.
Tony?
And Jonathan, the move to crude to 150 a couple of years back certainly prompted a long-term thought process around moving away from crude or carbon-based energies. What impact do you think the green policies of the world will have over the next 5 to 10 years? Are we going to see crude prices continuing to push up to $200 a barrel, or will the world move away from the dependency?
I think the move to 150 was a wake-up. That's all it was. It was a wake-up for people to say, let's look at our alternatives. Now, the alternatives are there, but at the moment with prices at these levels, they're just not economic to produce. So it's a wake-up, and it's also a wake-up to say, well, hang on, let's start to reduce our emissions, let's start to move to cleaner energies, and I think that is good because it'll then diversify what we have in terms of our energies.
You say that with oil around $80 a barrel, that there isn't a huge urgency or impetus for people to put a full speed on those green policies, though?
At the moment, you're 100% right. It's just not there. So if, in fact, prices start to move upwards through to that 85, 90 or even 100, then full steam ahead, because now the policies are in place to do it. It's just a matter of turning them up.
Making them economically viable. Sri?
Jono, you mentioned the payrolls number tomorrow. Isn't that going to be very difficult to cut through, especially with all the weather-related distortions? How do you think the market is going to trade on the back of this? Yes, we saw some constructive ADP numbers. Perhaps it bodes well for the payrolls at the end of the week, but there's going to be a lot of noise.
Oh, look, there's going to be a lot of noise, but I think what we're looking for are just signs that, I mean, that's a number that the market's really focused on. And they're saying, well, look, if in fact numbers pick up, then we know the economy's moving. It just makes sense. The numbers haven't been performing the way we'd like them to perform. So that's holding back a lot of investment. As soon as we can start to see the positive, remember our expectations are for a number that's not that positive. But if in fact that turns around, then that might be just a little bit of a sign that people will say, hey, hang on, things are picking up. This is perhaps good. We will need these things, and as a result of that, some of our commodities will continue to have a strong rally, and I think oil will go up with it.
From the black stuff to the yellow stuff, is there any reason, apart from the weaker US dollar, for gold to have moved up recently?
Gold, I think it is just US dollar. I mean, we've noticed with the SPDR where we've seen an increase in tonnage. So investors are moving back towards gold. expectations perhaps on the inflation side as well down the track, that's there. But at the moment, the US dollar index is poised to have quite a difficult time if it stays below US 80. Have a look at that on the charts, because that could correct all the way back down to US 78. Now, that will support gold to our targets of around about 1150 and maybe higher.
Great to have you with us as always. Jonathan Barratt from Commodity Broking Services.